There we go. Hello, everybody. Welcome to our first live We Talk Money episode on the new channel. We used to do the full episodes on my channel at Chris Dunn TV, but we decided that We Talk Money was so damn special that it needed its own dedicated channel. So if you're not subscribed, go to youtube.com/We Talk Money and subscribe to the channel, because that's all we're going to post here is clips and full episodes from this dedicated show. How are you guys doing today?
Fantastic.
Markets are bouncing, so that feels good.
Yeah, and I see that the S&P is now, back above the 200-day moving average, but testing a huge breakout zone. So that's interesting.
Yep, we got Bitcoin trying to break out above 28K. We've got so much to talk about, from AI to macro to the banking crisis to interest rates to regulators on the warpath. What else is going on? Housing, commercial real estate. Man, I think we've kind of left the time period where they said, there's decades where nothing happens, and then sometimes there's days that decades happen. I feel like we are permanently in the mode of like decades happening in the span of a couple of weeks. Just feels like with AI and with the economy where it's at, things are just speeding up, right? The rate of change is picking up. And there was even a call by a lot of the leaders in AI calling for a pause of the development. Trav, do you have an opinion on that?
Well, I think it's funny that it is headlined by Elon Musk, who has had no problem publicly beta testing his self-driving software for the past 5 or 6 years on public roads. And he didn't seem to care about that then, but now all of a sudden, all these LLM models are creating all sorts of use cases, and he wants to pump the brakes. Like, come on, bro. Come on, Elon.
Yeah. It's one of those things where it's like, oh, maybe we let the cat out of the bag and we need to rein it back in. But even if we do try to do that in the West, like China's not slowing down. So
absolutely not.
We would just like fall behind, right?
100%. I mean, the cat is out of the bag, like you said. I don't think you can put that back in the bag. And I mean, it's amazing. So GPT-4, ChatGPT-4, it's amazing because not only did they train the model on so many more parameters and it's even more accurate than it was before, but now what really got me excited was this whole plugin, the whole plugin product around ChatGPT. Now you can access the internet. You can plug into reservation systems. You can have a programming sandbox. Like the power that the plugins give ChatGPT now is creating just all these amazing use cases that we're just hearing about for the first time. And like literally every day I see something new and exciting coming out. And I'm like, wow,
yeah,
this is definitely a game changer.
It's wild. And I feel like, I probably spend anywhere from like 3 to 5 hours a day on AI. And I feel like I can't stay caught up. There's just so much happening that it's like, it's virtually impossible to keep up with everything that's coming out. It's just a flood.
Can you go back to that screen? I wanted to see what it said about Instacart.
Yeah, you can order for
your favorite.
So there was an example of basically where somebody plugged in like, hey, create me a diet and meal plan based on certain criteria, and then it would link to Instacart, and you could just have GPT basically place the order for you. So it would create the menu, it would create the recipes and get the groceries to you.
I can't help but wonder just how productive humans are going to become. Either that or how lazy. It could really go either way here.
Well, isn't laziness what drives human innovation? I mean, that's what I think what drives me to want to move forward is to find easier and faster ways to do things, right?
Yeah, for sure.
Cool. All right, well, let's go ahead and get rolling. Welcome, guys. I see people are starting to make their way in here. Do me a favor, hit the like button, share this up. If you guys are listening to the podcast after the fact, please leave us a review on your favorite platform. We're going to go into growth mode this year and really try to build the audience. Now that we moved over to this dedicated channel, we're going to do more live streams. We got more interviews with guest speakers that are going to be coming on the show, and I'm just stoked for the direction of this. So without further ado, let's jump in and start with the markets. Let's look at the charts and just talk about where we are and kind of what our plans are, because the The theme of this show is we're going to talk about the banking crisis and also how we're making adjustments to our investment and trading plans based on all the uncertainty that we have in the markets right now. And if we take a look at Bitcoin's chart, you can see that we had the bounce off of 19K, which is where I was dip buying, sold a little bit into 25 and then added back. And so I'm still holding a majority of my Bitcoin long. And one thing that I'll just kind of say in the spirit of how I'm adjusting my trading plan for this year is I'm being ultra conservative with alts because of the regulatory pressure and basically the full war that the US is bringing against crypto. I just think that there's a heightened level of risk in altcoins, and that is reflected not just in my opinion, but in the Bitcoin dominance. So basically, Bitcoin dominance shows what percentage of Bitcoin's market cap makes up of the entire crypto market cap. And after 2021, it fell from the 70% range down below 50 into the high 30s. And we're currently testing the high 40s. So basically, Bitcoin is about half of the current crypto market cap. And I am anticipating a breakout above 50%. I just think that there's a lot of alts that still need to bleed out. And I think if Bitcoin gets a break above this current level, that's going to drive that even quicker. But that's really, that's my thesis, is lighter on alts, at least in the short term, waiting to see how the Binance situation unfolds, because Binance has been slinging so much of the trading volume. And, with pressure on a lot of these alts, I don't know, man. I'm not immediately bullish, but I say that. And then, I even sent an alert out to the community and I said, we're kind of living in the twilight zone, because with Bitcoin flat, it's kind of strange that something like Ripple is actually showing some relative strength. So I've been trading Ripple since the early days, and I've got a lot of history with this chart. Me and old Rips go way back, and I know how he likes to trap and really, do fake out breakouts and things like that. So I've been skeptical, just kind of sitting back and watching this. But I know there's a lot of eyeballs on Ripple with the lawsuit, and there's really a lot hinging on that. So anyway, I want to kick it back over to you guys, and let's talk about the stock market and also just the banking crisis. And maybe we can start there at the top, looking at where we are with the banking crisis and what the most important things are that people really need to be thinking about right now, and what could cause it to A, either get worse, or B, significantly improve. Travis, why don't you kick us off, man?
Yeah, well, things evolve day by day in this whole banking crisis and stock market of 2023. It seems like so long ago that we were worried about the collapse of all the regional banks because of the collapse of Silicon Valley Bank. That was only like 2 weeks ago. So, it was just last week that the Swiss government was brokering a distressed deal for UBS to buy Credit Suisse, right? So as we watched, the KRE and regional banks and other European banks trade over the past few sessions, they have stabilized some. So that's good to see. What you like to see is volatility just slowly work its way down. You like to see, things stop whipping around as hard day to day. So we have seen that somewhat, and that's good to see. But we have to keep in mind what happened back in 2008. Now, again, I don't think what we're seeing in 2023 is going to look exactly like 2008. I'm not predicting another 2008 type of crash. But when you have a banking crisis, it's good to look at previous episodes, whether it's 2008 or 1990 with the savings and loan crisis. And so when I look back at 2008, what happened was we had Bear Stearns fail at the beginning of 2008. And we had that whole JP Morgan purchasing Bear Stearns, very similar in some ways to what we saw with UBS buying Credit Suisse. Yep. And then there was a little bit of quiet in markets. Markets actually rallied a little bit from like May through like the late summer timeframe. And then as summer started to approach its end, we started to see stress popping up in the financial system again. We had the Lehman failure essentially overnight in early September. And then after that, the markets, not only financials, but everything else basically fell off a cliff through the end of the year. And that I'm not saying that is exactly what's going to happen in 2023, but that's the risk that a lot of people are worried about. They're worried that, yeah, it's calm and things are starting to perhaps improve, and maybe the crisis has seen its worst peak. But what if we haven't seen the end of it? A lot of people do believe that there's still further dominoes to fall in this crisis. And I would tend to believe that the market will probe around to see where the other dead bodies lie before it's all said and done. So I'm of the mind that we probably are not fully through with it, but we could be in a period for a couple months where the market's digesting other things, and then all of a sudden it pops its ugly head back up. So we'll see exactly how it shakes out, but certainly areas to watch would be things like credit spreads, things like rates overall, of course, things like commercial real estate, which we know the regional banks still have massive exposure to. It's not just treasuries exposure that people are worried about with banks. It's also real estate, which we know has been under pressure with higher rates. So we can talk more about commercial real estate because that's a whole subject on its own, but that's kind of how things are. We've had a few days of quiet, and the question is it all over? I'm a little skeptical, but it's nice to see that the volatility's calmed down.
So a question that I've been trying to answer for myself, and I've been looking at arguments from both sides of the aisle, from like the Keynesian, central banking perspective, and then also from like the hard money, like Bitcoiner and gold bug perspective, about the quote unquote stimulus or QE that's happening. And I actually have been feeding ChatGPT quite a bit of like articles and summaries and asking it to make arguments from different points. And I asked it to explain to a fifth grader the BTFP program. And maybe Nikki or Travis, you can explain what that is. But I think the analogy was pretty interesting. It says, think of BTFP as an emergency loan system for banks. Let's say that you own a grocery store and suddenly a lot of your customers want to return their purchases. You'd need cash to refund them, but you've already spent that cash on restocking your shelves. So you go to a friend who agrees to lend you the money needed to refund your customers using the items on your shelves as collateral. What do you guys think of that? Is that accurate? Yes or no? And also, do you think that this is going to lead to more inflation, or is it not going to spike inflation?
Is that accurate? I mean, I think it's close, but my understanding of the program is that basically banks have these bond portfolios on their balance sheets. And what they're doing is these bond portfolios are down, maybe worth 70 cents on the dollar. So they go to the Fed and say, hey, Fed, I have these bonds worth 70 cents on the dollar. Can I get a loan for 100 cents on the dollar? And the Fed gives them the loan using their bond portfolio as collateral. But the bond portfolio is not, it's down, right? So the Fed is giving them 100 cents on the dollar for a portfolio worth 70 cents on the dollar. So it's kind of like, if you think about it, Chris, I think we talked about this. When you think about the DeFi stuff that was going on, and you would, pledge your Bitcoin or your crypto as collateral, and you would get a loan, right? Well, they would require a high loan to value. They wanted your assets to be worth a lot more than the loan that they give you. And so imagine the opposite of that, kind of.
Mm-hmm.
Yeah. And from the Bitcoiner and like hard money argument, it's like, well, yeah, that's inflationary. It's bullshit on certain levels. Like, I get that argument. Travis, what do you think, man? Is that what's the overview of the program as you understand it? And also, like, is this going to be inflationary or not?
So Nikki pretty much nailed it. The program is almost exactly what she says, and it has a 1-year term. And we do have to remember the assets that are being used for collateral here are treasuries. They're highly liquid. And the goal, I think, is for the Fed to essentially allow these banks to hold these till maturity, because, these bonds will actually eventually be redeemed for par, and they'll also earn interest as they hold them. So, these aren't toxic assets necessarily. I mean, I guess you could characterize it if you really hate the U.S. government's balance sheet, maybe you could classify them as toxic. And we could have that as a separate conversation. But, the world financial system generally views treasuries as a very safe haven asset and a very liquid asset, even though right now, a lot of those treasuries are down in value. If you were to hold them till maturity here in a couple of years, they would eventually be paid back par and, of course, paid interest along the way. So the Fed is basically saying these assets that might be in the market valued at 80 or 85 cents on the dollar today, we're willing to lend against 100% of their value because we know over the next couple of years, they will eventually work their way back up to par value.
And because
so
they will reduce rates.
Yeah, exactly. Yeah. Well, and that
portfolio
actually is
value.
helping too. As rates come down with the crisis, the values of these bonds are already going up. And so that's an interesting component as well. But yeah, this program is meant to be temporary, last a year. And it is meant for banks to essentially swap their bond exposures and take cash from the Fed. And so people will say, well, is this QE? And there's this big debate going on. And you could, I like listening to people who kind of work through the logic, people like Lynn Alden and Colin Roche, who are just great level-headed macro thinkers. And I agree with them in essentially saying that while this isn't your typical QE, it is obviously helping to restore value to banks' balance sheets. Now, are banks going to go out there and lend this cash collateral they now have? Probably not. They're probably going to let it sit there safe in cash for now because of what we just saw with the crisis. So even though the Fed is essentially giving them more value than maybe the collateral is worth today, and you could consider that a little bit of QE, they're essentially buying bonds back from these banks. The money won't be transmitted into the general economy in the way that it normally might, because it's just going to sit in cash on these banks' balance sheets.
Gotcha. Well said, guys. Biden says the White House response to the banking stress is not over yet. What do you guys make of this?
That might be the smartest thing that Biden said in months.
Yeah, it doesn't feel over.
Yeah.
Yeah, no, again, it's like I said earlier, it could be, we could have, there's several possibilities here, right? We like to think of possibilities and probabilities. There are several reasonable possibilities in my mind. Could we have seen just a flash in the pan crisis? The Fed's dealt with it quickly and we're able to, essentially cut off any further problems? Potentially. I put that at a lower probability than another scenario, which is that we might be in a time of relative quiet after the 2 or 3 weeks that we had prior. And we might even have a couple weeks or a couple months of relative quiet. But is it over? Probably not. There's probably going to be some other dead bodies out there that we're going to find. And then there's another possibility, which is, we're just in like a few days of pause and this is going to resume itself in 2 weeks. So yeah, I think Biden's probably right that there's still issues in credit in the banking system that have yet to fully work themselves out.
I guess the question is it manageable? Like how bad can this get? Especially with the commercial real estate side of things. That's what the market is like trying to figure out right now, probably.
Absolutely.
Yeah. Last week we talked a lot about Balaji's $1 million bet that we were going to go into hyper Bitcoinization and, how that was a very, very probably low probability event. At least in the next 90 days. But I think it is important to look at those low probability events and just have a plan for if they play out, right? Not that we're going to throw our portfolios 100% into Bitcoin today.
Please
but
don't do that.
Please don't.
Yeah, I mean, look, I think balance is the key, right? Like anybody that is on social media, beating the drum that they know how this is going to play out either has an ulterior motive or has a massive blind spot. So, that's why I've just been having a lot of fun with ChatGPT to try to come up with prompts to help me find my own blind spots as an investor, right? And I'll approach it and I'll say, okay, GPT, I am a Bitcoiner. I believe in these hard money principles, and I'll outline it. And I'll say, these are the risks that I see with the financial system. Now argue with me as a central banker or from the standpoint of, Paul Krugman or whoever, right? I'll insert a Keynesian guy, and then I'll have a debate, right? And what I'm trying to do when I do that is find blind spots or find weaknesses in the other side's argument, right? I think it's just such a good tool for that amongst millions of other things we're going to use it for. But that's one that I think anybody can use just to try to challenge their own beliefs and see if they are missing something.
Absolutely. I feel like Twitter has become just an echo chamber of like just being just bear porn. Like it's it's like
Yeah.
everyone's just bare back patting. Like, oh, you say something very there's no one out there that's like really looking at both sides and just really trying to critically think through this whole thing, because I don't feel like it's simple. I feel like there are a lot of nuances, and
Nikki,
I don't
you
know.
laid out a pretty good bull case the other day. I saw some bullet points of yours that you were thinking about. You want to talk about that? Like, what could be the bull
Yeah.
case for stocks right now?
I wouldn't call it a bull case, but I would say something that I've been thinking about a lot is how inflation declining or decreasing, right? Disinflation, how
Mhm.
disinflation is going to affect the consumer possibly in a positive way. And in terms of disposable income, right? And I was on a Twitter space yesterday, and I kind of outlined this whole kind of, I call it my, my macro theory, or I'm just kicking this idea around. And basically I kind of presented it, and I was told that I basically am wrong, and that this disinflation will not lead to more disposable income for the consumer. And two people kind of did the whole, bear porn stuff, and I'm crazy, right? So I didn't really have the energy to kind of argue my point in that moment. But my point was, within disinflation, within inflation declining, sure, when you have inflation declining, it doesn't mean that prices overall are declining, right? Prices are staying the same. And if we have 0% inflation, prices are still the same. And overall, we haven't seen a decline. But when you look inside of that basket of goods, right? You have that basket of goods that we're measuring inflation with. When you look inside of that basket of goods, there are parts of that basket of goods that we are going to see prices decline. And they are important things like gas, airfare, utility bills, maybe even rent. We'll see how that plays out. But the rent can decline. It usually goes up over time, but there are periods where it can, decline. So my point was was that there are pockets of the basket of goods that could help the consumer if, big capital letters if wages, stay the same. If people hold their wage gains, whether that's they got their raises at work, wages are pretty sticky, whether that's retirees that had cost of living adjustments for Social Security that were the largest they've seen in a very, very long time, if ever. And so, if that stuff sticks, if that income sticks, those categories within that basket of goods that decline could end up helping the consumer overall. Autos, used cars was another one that the prices on that have been declining year over year. So I kind of was told that my theory, it doesn't make sense because there's no way disposable income will improve, but we actually have seen it kind of slightly improve as inflation has come down because of those, pockets within the inflation data.
I think your theory holds water. I mean, if you think about what you're saying, you're essentially pointing to the fact that real disposable incomes, which is what people actually feel after the effects of inflation, your income adjusted for things that really matter to you, food, gas prices, your rent prices, things that matter to your average consumer. That absolutely seems like it's improving a little bit here because we've got gasoline and energy prices down year over year. Certainly some areas have seen rental prices start to pull back. You've definitely got some food categories now that are showing a pullback. Like if you look at commodities generally year over year, they are down quite a bit for the most part. There's a few that have bucked the trend, but for the most part, most major commodities are down year over year.
Yeah.
And even if you look at the official inflation figures, which we know don't exactly map one-to-one with what people are really feeling in the real world, the CPI numbers, the Cleveland Fed nowcast is suggesting that the March numbers are going to come in at like 5.2% year-over-year inflation, which would be down from 6% last month. So that's a pretty significant move down from 6 to 5.2 in the span of 1 month. And we also know that the CPI numbers are going to get a benefit from lower rental inflation figures that get put in the CPI. That's the largest component of CPI. It's almost 30% of the CPI's weighting is owner's equivalent rent. And we know, because it's a lagged measure, we already know that from the months of like May or June through the end of summer, it's going to really be putting downward pressure on the CPI. So we could be at like 3%, 4% CPI by like midsummer. And I think you're right. Like, I think even not only the official figures, but also what consumers are actually feeling in their pocketbooks, real discretionary income could actually be up. And then, of course, the big question then is, well, what if unemployment goes up too much? What if people lose their jobs? And so what you really need to see is real disposable income keep improving and unemployment remain low. And right now we have that. So yeah, I mean, banking crisis aside, you're right that outside of that, we're still seeing like relatively good economic news for your average consumer.
Yeah. And, you know, when I was told that disinflation doesn't help disposable income, I wanted to say, like, okay, are you telling me? I know from firsthand experience, when gas prices were at their peak and they went down, and instead of costing $100 to fill up your tank, it cost the consumer $70, right? And they're doing that multiple times a week. You're telling me that that's not helping the consumer have a little bit of extra cash for other things, for other important things, groceries, bills, whatever. You're crazy. Like, just because. So that was my point. That's my my theory. It's not even, it's just something that I'm considering going forward when looking at both sides, when looking at the risks and looking at, you know, the possible things that could keep this economy and this market kind of more resilient than people are giving it credit for. And maybe the stock market does have the same idea that I have, especially with when you have people that can invest in treasuries now. They can invest in CDs. They can lock in yield to protect purchasing power. Well, if they're locking in yield to protect purchasing power, and you know they're getting paid and they're protecting that, then you know what does that look like as inflation continues to decrease? So yeah, I don't know. That's where my head's at. Just trying to think through everything. You guys know I'm not super bullish, super bearish. I've been very flat, choppy market. Anything can happen from here. So I'm always just trying to look at both sides.
Yeah. I mean, it to your point, it does look like, you know, the stock market is obviously forward looking and it's looking pretty bullish at this point. There's a potential breakout at 13K on the NASDAQ. And so you can see Bitcoin is also kind of closely following that type of price pattern. It's actually been leading stocks where it's made a higher high, where stocks are kind of an even high. So I think the next couple of days around this 13K zone are going to be really telling. It's either going to be a double top or a big short squeeze.
Yeah, and just to kind of close all of these thoughts, this really does depend on the labor market. If the labor market is as strong as everybody's saying and it holds up, you know, that's what could be the wild card here that could make things go differently. And then the other side of that, like we've talked about, Travis, is earnings season, right? We're coming into a new earnings season. We need to hear what management is saying about how they are seeing customer demand in so far in the year. We had a little taste of that with Lululemon yesterday. That's a consumer discretionary corporation. They're not seeing any deterioration in demand really significantly. It's quite surprising.
Massive gap today on Lulu. What happened?
They had earnings, and the earnings, you know, beat expectations. Guidance was healthy. You know, they've got a lot of growth levers that they're pulling right now to try to expand business and bring in different revenue streams. And this is just a company I've been bullish on since 2017, since I discovered it. And they're just killing it right now. And with a weakening consumer in a recession, you know, looming, they have a stronger consumer base, a higher end consumer. Really, what we need to be thinking about is the lower end consumer and how all this is going to affect them. But as far as this goes, people are still buying yoga pants and $20 yoga pants, and you know.
Hey, we need one of those round of applauses for Nikki, because she's just absolutely crushed this one.
Yeah, absolutely. I mean, yeah, you know, retail is a place where I feel like female investors would probably do much better in, because you guys are just dialed into it.
I mean, Ulta's another one. Like, was that on men's radar? I don't think so.
I only spend an hour or two a day looking at makeup companies. They do makeup, right?
Yes, good job. And skincare.
Yeah. Cool. Hey, let's talk about the disaster that is commercial real estate. Oh my God. Work from home. Nobody's going back to the office. What's happening? And could this be the catalyst for '08 financial crisis or worse? I've seen some threads popping around Twitter, and a lot of people are starting to talk about this. What are the risks and what's going to happen?
Yeah, this is widely seen as potentially the next big shoe to drop for not only the market, but also for banks, which, regional banks have like, I think 2/3 of all commercial real estate lending flows through regional banks in the US. So they have huge loan books of commercial real estate, not all office. Some of that is office, some is going to be industrial warehouses, some of that's going to be probably, little shopping malls, some of that might even be data centers and things like that. So, commercial real estate as a category is very complex and broad. So we do have to remember that. But particularly on the office side, if you look at the major office REITs like Vornado or Boston Properties or any other major ticker in public markets that deals in office real estate, you can see that their share prices are mostly hitting 52-week lows. And when you look at their transcripts of their earnings calls, what you hear is just a lot of doom and gloom. They're saying basically that the financing markets, because interest rates have increased so quickly, the financing markets are closed to office real estate and new office real estate developments, unless you want to pay like 10% plus types of interest rates, which isn't really viable for a lot of commercial real estate. So you can see all these signs already out there that, particularly in the office side of commercial real estate, we have weakness. Cities like San Francisco are especially hard hit because you have tech companies downsizing their office space. Dropbox, which is a company I own, they spent a couple $100 million a few years ago building out a new office space. And now they're looking to sublease it. And they've been having difficulty subleasing that space, even though it's a premier brand new office space in San Francisco, because there's just not the demand for it there as other companies are shedding real estate. So there are definitely problem areas. We know that the CMBX, for instance, the commercial real estate derivatives out there are hitting fresh lows as well. That's suggesting distress among potential commercial real estate properties. You've got big high profile names defaulting on individual properties already in commercial real estate. So that snowball has already started to roll down the hill. And the question is, how bad could it get? And what could that mean? Could that blow up the regional banks? Certainly, I think we could see some regional banks with some need to raise capital or worse because of their commercial real estate exposure. The one thing I will say, of course, is that it is kind of a slow burn. There's not like one immediate catalyst. It's a little bit unlike it's a little bit unlike, say, treasury bonds, which the market marks to market every day because they're traded prices. With a lot of these commercial real estate portfolios, the loans might be 5-10-year loans, and they might not go bad for a few years. And these defaults may just show up slowly over time. And so the question is, what's the catalyst? Are you really going to see like a very quick catalyst that's going to blow up all the banks at once? And that's a little bit harder to figure out. I think there is unclear timing as far as catalysts are concerned. And if rates have to be pulled back in, if the Fed actually ends up reducing rates, that would help. That would help ease the situation. I think we could see a situation where the Fed is essentially at some point, maybe this year, maybe next year, forced to choose between letting the parts of the commercial real estate market blow up and reducing rates. I think the Fed is going to have to make that choice. I think the markets will probably force them to make that choice. It could be through the banking sector. It could be through something else, but commercial real estate is an actual problem. It's going to be with us. This problem is going to be with us for months. So just be prepared.
This is a chart that I think is really interesting. It's showing the U.S. metro office space vacancy percentage, and it goes back to the early 2000s. And you can see before the '08 financial crisis, the vacancies were at, I think, all-time lows back around like 13%. And then after the crisis, they went higher and things started to improve. And then COVID hit, right? And everybody went home. And then you got a little bit of a dip from people starting to come back into the office. And then now vacancies are at an all-time high. And this was saying no rent is being paid on roughly 1/5 of all U.S. office space. That's a crazy amount.
Yeah. I mean, I think the normalized figure, pre-COVID was what, like 15% or 16% pre-COVID. So it's not like there's always going to be some vacancy because of new builds and people transitioning out and whatever. But yeah, I think we're at an all-time high. And so that can be pretty scary.
And I was thinking about this more as like an anticipatory thing, right? Where it's like, yeah, we're only a few points higher than pre-COVID, but what does this look like in a year or two, right? Like, does this go parabolic? Do we get above 20, 25, 30%? Like, that's where things I think would just melt down really quickly if that happens.
That's financial crisis 2.0.
Agreed. And that's where the Fed, again, probably will have to choose between, saving the banking system and commercial real estate and pivoting. And I think they will choose pivot. They have to, right? I mean,
all things are pointing to pivot when you look at the commercial real estate market and you look at these bank bond portfolios. It's like the Fed could save everything if they just lower interest rates.
Yeah.
And so maybe, Trav, that's a really great point that they may just end up having their hand forced. And maybe that's why risk assets are looking bullish right now. I don't know.
Yeah, I mean, look, the market's, pricing in basically 3% into next year. So that's what we're looking at here, right? Is the markets are trucking higher, anticipating that outcome to happen. Where the bear case comes in, I think, is if there's a surprise where things melt down quicker and stocks dump and trap, and then they can't do this, right?
For sure.
Yeah. I mean, look, if inflation stays high, say we reverse the trend and mortgage rates start to go back up, at a certain point, it kind of balances out where the demand gets hit, right? And inherently that's deflationary. I don't know, man. You guys need to take this macro stuff because I just spin in my head. I just spin.
No, but you're right. It is a little bit self-correcting in a sense because pressure, on the financial system would be deflationary, which would help give the Fed cover to reduce rates. And so you're totally right. And I think that's what will happen. We're already, like I said, going to see the official CPI figures start to really come down over the next several months. And by mid to late summer, I think the Fed will have cover. I mean, imagine CPI is printing 3.5%, 4% in mid to late summer. And is the Fed really going to be up at, 5% Fed funds? And particularly if you start to get some stress in the financial system again, I highly doubt it. So I think the deflationary forces will then force the Fed to come in. And it's sort of this ping pong between deflation and inflation. We talked about, what was it, last week or week before, how we thought that the hyper Bitcoinization might come first via a deflationary event. First, you have the heavy deflation, you have the fiscal monetary response, and that's when you can get the whipsaw back into an inflationary environment, I think.
Yep.
The funny thing is, I thought that CEOs were calling for people to go back to the office more recently.
They are, yeah.
That's what I thought was happening.
I thought the Vornado's CEO or chairman, Stephen Roth, had some really interesting comments about this on the last earnings call. And, he basically said that he's like, Fridays are toast. He's like, people are not coming in to the office on Fridays anymore. He's like, it appears from the data that Fridays are done. Monday is kind of touch and go. He's like, but Tuesday through Thursday, there are a lot of companies that want to do the hybrid thing where they do have some employees come in. And I think that makes a lot of sense. A lot of employees actually want that. I certainly, enjoy the social aspect and the team building aspects of being in person at least some days of the week. And I think a lot of people share that view. So I think this all in or all out approach that people, the way they talk about, work from home versus office, I think is not the reality of what we're going to see. I think we'll see this more hybrid approach at most places.
Nice.
It still means though that there's going to be less need for office space overall, right? I mean, I think that's what's happening.
Not as much square footage for sure.
Yeah,
absolutely. All right, let's do some Q&A. What do you guys think?
Let's do it.
All right. I'll just kind of go backwards here. El Hombre was asking, is it smart to keep some cash of your investment portfolio in short-term bonds, treasuries, due to the higher rate and the possibility of a plateau in rates? If not, what are the quote-unquote safe alternatives? Great question.
Trav, you're doing a little bit of this right now. I mean, you ended up.
Absolutely.
Yeah, so you can take that.
Absolutely. Yeah, I love the idea of parking some cash into the 4.5%, 5% yielding treasuries. I guess now today those rates are a little bit lower, but overall, you can still get looking out 1, 2, 3 year bonds, you can still get 4% plus. On the really short-term stuff, the 6 month or less, you can still get 5% plus. And I think it's a really nice alternative. Why would you just have it sit in cash if you can earn that relatively risk-free 4 to 5% yield? So I've done that. Certainly, I think it makes a ton of sense. Now, then you kind of start to think about, well, how could I lock in 4 to 5% for a longer time frame? And that becomes a harder choice because, longer term bonds aren't really paying those level of rates. Longer term bonds with the 30-year today is trading like 3.5, 3.6, something like that. Even the 10-year, 30 years at 3.7, the 10-year is at 3.56. So yeah, I mean, unless you want to take on more risk, you're not really getting as fat of a yield. And you've got other duration risks there, long-term inflation risk. So it gets harder when you start to think about locking in rates for a longer time period. Those choices become more difficult. So I think it totally makes sense, like especially for shorter term cash, to park that in assets that are yielding 4 to 5% risk-free. And that will also benefit a little bit if we get a very fast reduction in rates. That will help bond prices, and you can actually get capital appreciation on the bonds if it happens in a super short time frame. But the capital appreciation on short-term bonds, it just isn't that much, even if they reduce rates a lot. So I think earning that yield is great, but it may only last a year or two, and we may be back in a low rate environment from here. But for now, it's great.
Awesome. So good way to, I guess, in the short term, just ease some of the pressure from inflation, right? Like if you were sitting in a ton of cash and you're like, oh my God, man, I'm just getting eaten up here. Yeah. Why not lock it up for 3, 6 months or a year or two at the most?
Yeah. Yeah. Awesome. Especially when stocks are still a little bit expensive, at least the ones I want to own for the most part.
Okay. Next question. I don't know if you guys have been paying close attention to this about the Square/Block short. I heard some chatter about it, but I didn't dive into it over the past week.
It was kind of a funny report, actually. So I believe was it Hindenburg Research, which has a pretty good track record with some of their short reports. And they basically had a long report that they've apparently been spending many months on with regard to Square, which is, I guess, now officially called Block, ticker symbol SQ, which Nikki and I have owned at various points over the past 5, 6, 7 years and done quite well on it. But a big part of the thesis was that Cash App, which is one of the big assets of Square's business, and it's grown a lot in recent years, that Cash App has been doing a lot of shady or potentially illegal things in courting customers that, are using it for illicit purposes. And, this argument is, I don't know how relevant it is to the actual, the business long term. Like the accusations were that basically like rappers were like rapping about how they were doing drug transactions over Cash App or committing fraud over Cash App. And it's like, well, we have this problem with almost any instrument of money, as we've talked about in the show many times, whether it's crypto or cash fiat or, a P2P app, whether it's PayPal or Cash App, people
or HSBC working with cartels.
Exactly. Like people are going to do this. They're going to find channels and ways to do that. And I don't think, Block has necessarily tried to allow it. It's just that it's a big enough platform where it happens. And so, yeah, I thought the short report had some interesting and funny points. I'm not sure that ultimately, unless it results in some big investigation and crackdown on some of their practices, I don't know that it really means a whole lot for the long-term trajectory of Cash App, but it was interesting to note. I do think Square/Block have other issues that they really need to focus on, which are cost efficiency, having margins improve again, really trying to make sure that they can maintain growth within P2P and also their B2B business. So yeah, I don't know. I thought it was an interesting report, pointed out some issues that for sure the company needs to address, but I'm not sure they were issues that were a long-term terminal risk for the business. I could be wrong. That was my assessment.
What did you think of Square's response?
I didn't really like Square's response. They basically were like, we're going to work.
Cringy, right? Like,
yeah.
They respond to the short reports sometimes.
The best way to respond to a short report is to like take some of the main points and just refute them and then say, we're very confident that we're doing the right thing and that this report is wrong for XYZ reasons and they can do what they want, but we're just going to keep running our business. The way that they responded was, we're going to work with legal advisors in the SEC to try to fight back. And it's like, okay, but the short sellers, they did the research. They pointed out some issues in your business. Did they lie about anything? Maybe if so, then you could maybe nail them on some things, but trying to get them in trouble with the SEC just because they wrote a report critical of you is a little bit catty, in my opinion.
We've seen some really funny responses from activist or from CEOs against activist short sellers in the past. And usually when it's a blatant fraud, it's like the bigger the fraud, the more aggressive the CEO is in the response, right?
Mm-hmm. Yep.
What are some examples that you remember? I'm sure
Nicola was the CEO, was pretty aggressive.
Yeah.
Yeah.
And that ended up being an epic fail.
Yep.
Yeah. Nicola, so it's like if you see that, then I don't know. Yeah, like you said, maybe the best way is just to not go too hard in the paint.
Absolutely. Yeah. I mean, some of the bigger frauds of all time, like your wire cards, your Enrons, like they tried to like hit back at short sellers who were actually right about the fraud. And, they ultimately ended up with egg on their face, but
be like Elon and make fun of the short sellers.
Yeah.
Sell shorts on your website.
That's right. Okay. Next question. DJ was asking, volume on the SPX has been steadily going down since 2008. Given that it's generally seen as a measure for the overall stock market, what do you attribute this to? So I've pulled up the SPX index, and you can see volume kind of declining here. But when we look at, like the futures contracts going back, there's obviously a higher volume during high periods of high volatility, but I wouldn't say that it's any lower on average, at least on the ES. What do you guys make of this? I'm scrolling through, there's several different tickers that represent the S&P 500, and I guess it depends on which one you're looking at.
Yeah, I really wasn't aware that there was a volume. I mean, you certainly saw some crazy volume peaks, around that financial crisis timeframe. Just pulling up the ETFs, the SPY ETF chart here. Yeah, for sure. Like you had pretty crazy volume in the fall of 2008, which is expected during a really crazy market event. You also had a pretty high volume print, during the COVID crash. But if you take those out, I mean, I guess there is a little bit of a volume decline from the overall, but that could also be because, there are flows into other related ETF assets. I mean, probably if you look at the QQQ, I'm guessing
I was going to say the rise of passive, maybe.
Mm-hmm. Yeah, there's definitely the largest volume was during that 2008 crisis time. And then the Qs have actually been kind of going up in average volume over the last few years.
Passive.
Mm-hmm. Yeah, interesting thought to try to track where the liquidity is going.
There's also been a lot more flow on the option side lately. The 0 days to expiration options volume, that's exploded. So perhaps a lot of speculative traders are now doing less futures and ETF volume and more options volume. That could be another explanation as well.
Mm-hmm.
Yeah.
Awesome. We had a couple of questions come through the website and in the community. RS was asking, so in practical terms, if you had an investment portfolio that you wanted to categorize from 1 to 5, meaning 1 being the least risk to 5 being the most risk, where would you place yourselves for the remainder of 2023? So
That's a great question.
Yeah. Like, how are you guys?
How risky is the portfolio on a scale of 1 to 5?
Yeah.
In 2023.
I'm at like a 2. Because I'm pretty heavy in cash and bonds. And then also I have my overall market hedges on to a pretty large extent still. So yeah, my net exposure is pretty low. It's not like flat or 0, but it's pretty low relative to prior years. So I would say I'm probably like a 2 out of 5. And now I'm kind of definitely just remaining that way for now because of everything we just talked about today. Some of the commercial real estate stuff, banking sector, volatility and rates and fixed income and and equity still not being that cheap, frankly, in a lot of cases. So yeah, I'm kind of waiting for a better buying opportunity to get more aggressive.
Yeah. I would say 3 because I've been buying into Bitcoin and DCAing a little bit in the lows and then building into like a breakout long and a dip buy long. So I've got the, managed futures accounts that are kind of a hedge. I'd say 3. Nikki, what about you?
I think I'm a 3.5. Like I am heavy, risk assets, equities. I don't have a whole lot of bonds. But I think that my portfolio has been positioned well enough to where even if we go into a recession, I've got a lot of defensive stocks. I've got Walmart's one of my biggest positions, Ulta and Lulu are some of my biggest positions, and they've been doing excellent, definitely outperforming S&P performance. And so I think that the choices I've made in terms of my biggest positions are kind of helping my risk profile going into 2023. And I've been harvesting cash. So that's why maybe while having a heavy equities portfolio, I'm not like a 4 or 5 because I have been focused on harvesting cash for having, the ability to add to positions if we see a sell-off.
Cool.
Makes sense.
Powell, I think I'm pronouncing that correct. Powell was asking, hey, Chris, what advice would you give for being lonely in trading and investing? Man, that's actually a good question. A lot of people that are trading from their homes are usually alone, right? You're sitting there in front of your computer, and thankfully we have the internet, so you can connect with other people through the interwebs like we're doing with you guys right now. And that's also why we do the community, over at the Skill Incubator. If you go to wetalkmoney.com/community, you can check that out. We have Discord channels and, we do live classes and things like that. And for me, it was whenever I went full-time into trading in 2007, I felt that it was very, very lonely. And so I had a small group of guys that we were kind of trading together. And then in 2008 and 2009, I stepped up that process in a big way of trying to curate a community of like strategy developers and traders and, full-time pros and beginners. And I just think you have to make a concerted effort to connect with other people, because what also happens is if you're an investor and you're by yourself, you are limited by your own perspective, right? So you could have blind spots or you could have opinions that, maybe you haven't fully thought through. Trav, how do you think about this from like the hedge fund angle too, right? Because you came from the hedge fund world where it was like several analysts and you guys would kind of make decisions as a team, and now you're kind of solo and you're also providing ideas for the community. What are the pros and cons you see of like being at a hedge fund where you're trading and investing with other people versus solo and kind of having like an online community as well?
Yeah, I think what you said is basically how I've approached it, which is to say that, finding the community online that you engage with and you can trade ideas with and bounce ideas off and ask for feedback. And that could take several different forms. Obviously, we have our community, which I spend a lot of time in and really get a lot of value from myself. And then also even things like the FinTwit community and, like interacting with people on Twitter and sending feedback between Twitter users on different pieces of data. It could be listening to investing podcasts and also things like that. Like I think are a way for me to kind of interact at least at some level. A lot of times, after I read a newsletter post from a paid newsletter that I subscribe to, I'll send feedback via DM and we'll go back and forth or we'll email or things like that. So that helps a lot. And I would say, at the hedge fund, it was less of that and obviously more of the in-person analysts talking to each other, trying to defend ideas, super, super helpful. But, I'm essentially trying to take what we had there and do it in this kind of virtual environment. And I think it's easy to do if you find the right people in the right communities online. Like you can still absolutely have that.
Yeah, well said. Nikki, anything to add?
It's funny because I do a lot of different things, you know, between financial planning and managing my own full portfolio and making content and just everything. And yesterday I spent some time doing some investment research, which I kind of got a little bit, you know, busy with other stuff and I wanted to get back to it. And I was just, you know, doing my research and looking at different stocks and just talking to people in the community, talking to our members in the community about certain cybersecurity was our topic of conversation. And I just had the biggest smile on my face. And I realized just how I'm happiest in those moments when I'm doing my stock research and I'm chatting with community members and getting different perspectives. And it's just so valuable. So it's my favorite thing to do. And I hope that other people in our community, you know, get the same value and smile on their face when they're chatting with us.
Yeah, I think so. I mean, nothing beats doing an in-person event, and we definitely need to do one this year.
We've been asked multiple times.
I know. The last time we did it was in Amsterdam right before COVID. And then we had Cayman Islands before that. So
it's time.
Let's get back out there.
Yeah.
Hey, one more thing I wanted to ask you guys about is the TikTok ban. You know, I watched part of the interrogation of the CEO, and it was entertaining. I mean, they pressed him at some hardline questions, and I've kind of teetered back and forth on this thought of, you know, should we ban it? Should we not? I see pros and cons, and then like the language of the bill actually came out, and I was like, holy shit, that's scary. You will not be jailed for 20 years if you use TikTok after the ban, despite the internet fear mongering. So it's like one day I'm looking at things and I'm like, oh my God, they're trying to ban crypto in the bill. And, you know, it looks like they're going to, you know, put this authoritarian language in. And then I read further and I teeter back the other way. Where do you guys currently stand on that issue?
These bills are scary. You know, these huge bills that have all this stuff inserted from lobbyists and from, you know, different reps that are looking to stuff into these bills. You know, these bills become these massive 1,000+ page things that have all these things in them that probably shouldn't even be in them, but people are trying to sneak in. And it's quite terrifying because there's a lot of unintended consequences. You know, that's what people were worried about when they read the part about having a VPN could get you in trouble, and you know, on certain websites or that had to do with certain, you know, governments across the world. If you're using a VPN to mask your activity around those particular sites, then you could be facing jail time up to 20 years. I mean, it is kind of crazy, right? It's kind of crazy to think about that. One of these bills, like a small part of it that people aren't paying attention to, could be used to persecute someone. And so I think it's extremely concerning. I think the legislative process is very broken in the U.S. And unfortunately, I don't know how that gets fixed. But you know, and sometimes maybe we overreact to certain things, and that I think is a good feedback mechanism for these reps to like take these provisions out. So I'm glad someone's doing it. Maybe AI can also help us to like find these provisions in these mega bills like this and to try to root some of this stuff out. But yeah, you know, I guess what I'm ultimately getting at here is I have very mixed feelings, because the bills are definitely overreach and can be used in ways that probably people don't even intend them to. On the other hand, you know, sometimes like things just get thrown in and then they're not actually in the final bill, and maybe we worry about them too much. But if we don't worry about them, then we end up with Patriot Act bills that are used to persecute people, even that are citizens, in really terrible ways. So
Absolutely.
Yeah, I mean, yeah, so it's terrifying. We need to keep our eyes on things like this and try to, I guess, over time, vote out some of these bad actor politicians.
Yeah, well said. It's a very scary and interesting time that we're in right now, with the US absolutely overreaching in the crypto space. And, you know, now we've even got kind of a battle between the CFTC and the SEC. You know, the CFTC was calling ETH a commodity, and the SEC hasn't explicitly said it, but they're alluding to the fact that everything outside of Bitcoin is a security. And Operation Choke Point 2.0, as it's been called, is in full swing, and the US government is absolutely overreaching and just taking, in my opinion, very reckless steps. And so, yeah, I agree with you, Trav. Like, there has to be pushback and there has to be some change in the process, because the way things that are headed right now in the US, I mean, they're just absolutely driving talent and capital outside. And even Coinbase said they were going to open a non-US exchange, or whatever that looks like. I mean, this is what's happening. And you've got some places like the UK that are being a little more crypto friendly, and Hong Kong and Singapore. I mean, the development and the progress and the innovation isn't going to slow down just because the US wants it to. It's just going to drive it outside of these jurisdictions and make it harder for American citizens to get access to it. With that said, again, there's a balance, and I do think we want to do whatever we can to stop scams and, at major implosions. And I think that right now the SEC is just embarrassed because it's got the cake on its face from FTX and Celsius and on, right? And so it's just this knee-jerk reaction is just really dangerous and really harmful to the future of the space in the US. So
yeah,
I don't know.
I mean, it's interesting. I guess you had also asked about, TikTok specifically. And I do find it concerning that, we went through the whole rigmarole of, or the whole like controversy of TikTok sending data back to Chinese servers, like 2 or 3 years ago. And then it was like, oh, no, TikTok US is going to be split off into its own company, and Oracle is going to be the backend cloud provider. And they're going to make sure, that data isn't being transferred. And then it turns out 2 years later, there's still data leakage happening. And and that to me is extremely concerning. I think 3 of the top 10 apps in the US App Store over the past month have been Chinese based.
Yep.
And yet the Chinese ban a lot of, US app activity in their own app stores. And so I think it's extremely concerning. I think it's extremely concerning that, one, specifically to TikTok, that there was still data leakage and might still be today, that problem wasn't fixed. 2, that other Chinese apps, Temu and all these other things that are like dominating app stores, probably should be looked at as well in the context of, US-China relations. So there's real issues here that need to get dealt with. I just don't know if a 2,000 page mega bill that infringes the rights of US citizens is the right answer.
Here. Let's get an applause for that one. Oh man. Yeah. So much to think about. So I guess we could start to wrap it up. We've been going for about an hour, and, again, the kind of recapping the theme here, which is the banking crisis and how we're making adjustments to our investing plans. Just to, again, kind of recap mine. There's a lot of uncertainty. I've been trying to digest the macro picture. Obviously I'm not on Nikki and Travis's level with understanding just the inner workings and the implications of all this stuff. And I've been studying and trying to stay on top of it. And there's still, I think, macro is tough. Tell me what you guys think of this. My opinion is macro is tough because there's so many damn variables, and so much of it is just wildly confusing, and the outcomes are almost impossible to predict. And at the end of the day, I keep coming back to a few things, which is like, what is money, right? And how is money created, and what makes sense? And I think people are waking up to the fact that the government, just able to create trillions of dollars out of thin air is, and the debt-based economy, like those things, the hard money principles, I just keep coming back to those as like, that to me makes sense. And so I want to have some Bitcoin. Outside of that, I also want to own equity in companies that are doing well, right? And I want to diversify. I want to own real property. I want to own real estate. And, I hate to say it, but the strongest looking chart in the market right now, what am I going to say? Lululemon.
Well, it's definitely Ulta and Lulu.
Yeah. No,
sure.
Look at gold, man. Look at gold's chart. Again, this is not my desire or opinion. This is one of the strongest damn looking charts in the market right now.
It really is.
Whether we like it or not, everybody just put Peter Schiff on mute if this breaks out, because
I don't want to be blabbing. Yeah, but you know what? Bitcoin's running at the same time, so he really doesn't have much of a leg to stand on. Right?
I know. Yeah. And if you look at the CAGR of Bitcoin compared to gold, over the past, I mean, choose a time period, 5, 7, 10 years, whatever. It's like Bitcoin's been kicking gold's ass, but yeah, I just want to own these things. And so the macro picture to me is just, it's tough to understand. Nobody agrees because these aren't hard laws like the law of gravity. It's money is it's a confidence game, right? And if we lose confidence in the dollar, and right now, man, I mean, de-dollarization, that narrative is kicking into high gear. We didn't even talk about that with, Iran and Russia and the Saudis, trying to get out from under the petrodollar and the SWIFT system. I don't know. Is there anything you guys want to add to that before we wrap it up?
Trav had an interesting tweet around that.
Oh yeah.
Was it your tweet, Trav?
Yeah, it wasn't. Yeah, so I'd seen it on my timeline and I posted it to our macro channel in our community.
Oh, that's where it was. Sorry.
Yeah. And it was showing a newspaper clipping from 1975 when, there were a newspaper article writing about how OPEC was trying to cut their link with the dollar. And this was back in 1975. So I think generally the point is, this is not new. I saw for some reason this week, people were saying that all of a sudden, because CNN was talking about, and some other major news network,
Fox and CNN, I think.
Yeah. And I saw some comments that, oh, this is the first time it's made it into mainstream media. And so what is this telling you? But actually, like, I've seen this fear mongering about the US dollar and the fall of the dollar as the reserve currency of the world being put in mass media for many years, most of my investing career. So I don't think it's new. I do think it's real. I mean, it's clear that the Saudis, the Chinese, the Russians are all trying to, at least in the transactions among themselves, they're trying to diversify away from using the US dollar. There are a few problems. I don't think it means the near-term dethroning of the US dollar. For one, the US is the world's largest economy. So, those transactions between all those nations and all the other nations in the world with the US is still going to happen in US dollars. The world still wants to transact with the US because it's the largest economy. So that's number one. And so you will lose some transactions on the fringe, of course. I think that makes sense. But the other thing to keep in mind too is that, it's funny because like the Saudis still peg to the US dollar. Hong Kong still pegged to the US dollar, right? So it's like, if you're transacting in Hong Kong dollars or Saudi riyadh or whatever, you're essentially effectively still like tied to the US dollar via peg. So it's really strange to think about. So yeah, I tend not to get too worried or fearful about the imminent collapse of the US dollar as the world's reserve currency. But I do think it's a slow burn issue over time that is real.
What do you think about the idea of like the world basically splitting up into basically two major economies, right? The US led and then the Chinese led, where, you're going to have Europe and part of South America and the US and Canada. And then you're going to have China, Russia, and Iran and North Korea and blah, blah, blah. In that section. Yeah.
That whole multipolarity thesis, I think is for sure real. We're seeing, I cannot ignore that is happening already. China, the world's largest second or third largest economy. And they have a lot different views on political systems, who they're willing to work with, obviously the close ties to Russia, North Korea, et cetera. Like, yeah, I mean, I think it's real. I think it will have implications for many years. So we're, how that evolves will certainly have big effects on macro and markets. Yeah.
Cool. Okay. So my thing, buy Bitcoin, have some real estate, have some gold, have some stocks. I don't know, that's my thing. But also I want to have some hedges. So I've got the managed futures account that did 60% last year, which was a great hedge. What are you guys doing? How do you want to wrap this up?
I personally, I'm a passive investor, but for my active investing, aka stock picking portfolio, something that I'm starting to do is I'm starting to cut the fat, and I'm going to take a more concentrated approach. I think going in, for the rest of the year.
So you think it's a stock picker's market?
Oh yeah, I think we're going in. If we're not already in, I mean, valuations could get better in certain areas, but I think that this year is going to be a stock picker's market. I mean, we're always in somewhat of a stock picker's market if you know where to look, right? So that's what I'm doing, getting a little bit more concentrated and cutting some fat in the active portfolio.
Cool. And Trav, 100% of your portfolio is in pickleball startups, yeah?
I am heavy in pickleball, baby.
Aren't we all?
Okay.
Yeah.
Well, I outside of that, what are you doing, Trav? How are you making adjustments based on this potential banking crisis maybe getting worse, right? We talked a little bit about both sides of that equation, but
it's going to sound boring, but I really am just kind of playing it slow, building the watch list, building the list of companies that I want to buy if we do get a market panic, buying stuff here and there where I think there's some trade opportunities or where stuff has gotten cheap. I'm going to be spending some time on the commercial real estate sector. There's going to be some buys there with, the baby thrown out with the bathwater, so to speak. So yeah, so very defensive right now. Like I said earlier, still pretty heavy in cash, bonds, got significant overall market short exposure against my long portfolio, but still very actively looking for what I'm going to buy, areas in the market that are beat up where there might be buys here in the coming months and quarters. So that's kind of how I'm playing it.
Awesome. Well, we can go ahead and wrap it up there. Again, guys, if you're not part of the community, you can go to wetalkmoney.com/community. Check us out, come into Discord, hang out. Also come to tomorrow on Thursdays. I do a crypto market update. So I've got a lot of data I've been looking at this week and been having some fun there. So yeah, guys, Trav, Nikki, thanks for joining. And everybody, thanks for being here live. Again, this was our first live episode on the new YouTube channel. So make sure to subscribe to the We Talk Money channel on YouTube if you haven't come over from my original channel, and also subscribe and leave us a review on your favorite podcasting platform.
Absolutely. Thank you.
Absolutely.
Good show. We
Yeah,
didn't even get to everything.
I know. Gotta pack that in. We'll sandbag some of these questions and topics for next week. So we'll see you guys next Wednesday. Thanks for being here with us.
Ciao.
Cheers.